There is a mathematical formula that, if you truly understand it and apply it correctly, it will completely change the way you look at every single trade. Not a formula to find entries, not a formula to read charts, but a formula to answer a question that most traders completely ignore. How much money should I put into this trade? If you watch my previous video about the psychology of smart traders, you may remember that one of the 5 biggest traps was excessive leverage and oversized position sizing. I promised that I would make a separate video about the tool Edward Thorp used to solve this exact problem. Today is that video. But even if you have not watched the previous video, that is completely fine. I will explain everything from the beginning so you can fully understand it from this video alone. Most traders decide position size based on feelings. If they feel confident about a setup, they size bigger. If they just lost several trades, they size smaller. If they see other people going big, they also go big. This is not strategy. This is emotion disguised as decision-making. And in the long run, emotion disguised as decision-making will always underperform a rule-based system, even if that system is not perfect. The formula I am about to talk about is called the Kelly Criterion. It was developed not by a trader, not by a fund manager, but by an engineer at Bell Labs in 1956. And later, it was used by Edward Thorp, the man I mentioned in the previous video, to beat the casinos of Las Vegas and later beat the stock market for 2 consecutive decades. Before we get into the formula, I want to tell you the story of the man who created it. All because understanding the context behind the birth of an idea often helps you understand the idea itself far more deeply than simply memorizing the formula. John Larry Kelly Jr. was born in 1923 in Texas. He served in the United States Navy during World War II, then studied physics and earned a PhD from the University of Texas. In 1956, he was working at Bell Labs, one of the greatest scientific research centers of the 20th century, a place that produced the transistor, the laser, the C programming language, and countless inventions that changed the world. Kelly worked in the field of information theory, a new branch of science created by Claude Shannon at Bell Labs just a few years earlier. Information theory, at its core, is the study of how to transmit information as efficiently as possible through noisy channels. And while studying information theory, Kelly realized something fascinating. The problem of optimal information transmission had the exact same mathematical structure as the problem of optimal betting. In other words, the question of how to transmit information most efficiently through a noisy channel, and the question of how to bet most efficiently when you have imperfect information, shared the same mathematical structure. From that realization, Kelly wrote a short paper called A New Interpretation of Information Rate. In that paper, he introduced a formula to calculate the optimal percentage of capital to risk on each bet in order to maximize long-term wealth growth. Kelly did not live long enough to see the influence of his idea. He died in 1965 from a brain hemorrhage at only 41 years old, but his idea survived and spread through paths he could never have imagined. Edward Thorp was the man who brought the Kelly Criterion from theory into reality in the most impressive way possible. Thorp, as I mentioned in the previous video, was the American mathematician who developed card-counting strategies in blackjack in the late 1950s. When he realized that he could calculate the probability of winning each hand based on the cards that had already been dealt, he faced a practical question. Knowing that your winning probability is higher than 50% is useful, but how much money should you bet on each hand? If you bet too little, your statistical edge does not generate enough profit. If you bet too much, a short losing streak can wipe out your entire bankroll before your edge has time to play out. This is exactly the problem the Kelly Criterion solves. Thorp found Kelly's paper, applied the formula to blackjack, and the result was a system that not only had statistical edge, but also disciplined bet sizing. He later wrote the book Beat the Dealer in 1962, where he explained his system in detail, and that book became one of the best-selling books of the decade. After casinos changed the rules to fight card counters, Thorp moved into the stock market. He founded Princeton Newport Partners in 1969 and applied the same mathematical principles, including the Kelly Criterion, to capital management. In its over 20 years of operation, the fund achieved an average annual return of approximately 15.1% after fees, and it never had a single losing year, not one year. To compare, during the same period, LTCM, with a team far more academically elite, collapsed completely. The difference was not who was smarter. The difference was who managed risk size better. Now we get to the part many people have been waiting for. What exactly is the Kelly formula, and how does it work? I will not scare you with complicated mathematical symbols. Instead, I will explain it in language that any trader can understand and apply immediately. In its simplest form, the Kelly formula says this: the percentage of capital you should risk on an opportunity equals the probability of winning minus the probability of losing divided by the reward ratio. That sounds abstract. So, let me turn it into real numbers. Suppose you have a trading setup that you have thoroughly backtested, and you discovered the following statistics. Your win rate is 60%, meaning 6 out of 10 trades win. Your risk-reward ratio is 2 to 1, meaning when you win, you gain 2 units, and when you lose 1 unit. Applying the Kelly formula, the probability of winning is 0.6. The probability of losing is 0.4. The reward ratio is 2. So, the result becomes 0.6 minus 0.4 divided by 2, which equals 0.6 minus 0.2, which equals 0.4, or, in other words, 40% of capital. The Kelly formula says that with this setup, the optimal position size to maximize long-term growth is 40% of your total capital. Let's try another example so you can feel how flexible the formula is. Suppose your strategy is slightly weaker. Your win rate is 52%. Your risk-reward ratio is 1.5 to 1. It still sounds like a profitable edge, but Kelly gives a very different result. The probability of winning, 0.52, minus the probability of losing, 0.48, divided by the reward ratio, 1.5, which becomes 0.5, 2 minus 0.32, which equals 0.2, meaning 20% of capital. And one more example, win rate, 45%, risk-reward ratio, 3 to 1. This is the type of strategy that loses more often than it wins, but wins big when it works. Kelly gives 0.4, 5 minus, 0.5, 5 divided by 3, which equals 0.4, 5 minus, 0.183, which equals approximately 0.267, meaning 26.7% of capital. What is interesting here is that the third strategy, despite winning fewer trades, is allowed by Kelly to bet larger than the second strategy. Because the higher reward ratio compensates for the lower win rate, Kelly does not care about win rate alone, and it does not care about reward ratio alone. It cares about the combination of both. In other words, the total expectancy of the strategy. This is an important lesson. Many traders focus too heavily on win rate and completely ignore risk-reward ratio. They want strategies that win 70%, 80% of trades. But Kelly shows that a strategy winning only 40% of trades with a risk-reward ratio of 4 to 1 can actually be far superior in expectancy and allow larger position sizing than a strategy winning 65% of trades with only a 1 to 1 reward ratio. But before you run off and put 40% of your account into your next trade, keep listening. Because this is the point where most people who learn Kelly misunderstand it and turn a brilliant tool into a double-edged sword. 40% sounds enormous, and it is enormous. And this is why Thorp and most people who truly apply Kelly in real life never use full Kelly. They use something called fractional Kelly. To understand why, I need to explain an important characteristic of the Kelly Criterion. The Kelly formula is designed to maximize long-term growth rate in the strict mathematical sense. But on the path toward that long-term growth, short-term volatility can become extremely large. Try to imagine this. You risk 40% of your capital on every trade with a setup that has a 60% win rate. Then you encounter a streak of 5 consecutive losses. This is completely possible statistically, even with a 60% win rate. After 5 consecutive losses with 40% risk per trade, how much of your account remains? First loss, you are left with 60% of capital. Second loss, you are left with 36%. Third loss, you are left with 21.6%. Fourth loss, you are left with 12.96%. Fifth loss, you are left with 7.8%. You lost more than 92% of your account, and your strategy is still good. The win probability is still 60%, but you were nearly wiped out by a short-term losing streak that is statistically completely normal. This is the problem with full Kelly, though it is mathematically optimal over an infinite long-term horizon. But in real life, with finite time and real human psychology, its volatility is too extreme for most people to survive emotionally. Thorp understood this, and he recommended using fractional Kelly, usually half Kelly or quarter Kelly. In the previous example, instead of risking 40% with full Kelly, you would risk 20% with half Kelly or 10% with quarter Kelly. Your long-term growth rate will be lower than full Kelly, but volatility drops dramatically, and more importantly, the probability of complete ruin falls close to zero. To help you feel this difference in practical terms, let's compare two traders using the exact same strategy. The strategy has a 60% win rate, a risk-reward ratio of 2-to-1, and they each take 1,000 trades. Trader A uses full Kelly, risking 40% of capital per trade. In perfect theory, his account grows at the fastest possible rate. But in reality, during those 1,000 trades, there will inevitably be periods of consecutive losses. And with 40% risk per trade, those periods can cause the account to drop 70%, 80%, or almost to zero. At that point, psychology collapses. Most people will stop trading or change strategies long before reaching trade number 1,000. Trader B uses quarter Kelly, risking 10% of capital per trade. The growth rate is slower, but the maximum drawdown during the process is much smaller, usually only around 20% to 30%. Psychology stays more stable. Trader B has a much higher probability of actually surviving all 1,000 trades and allowing the strategy to realize its long-term edge. The final result for Trader B after 1,000 trades, even if theoretically lower than full Kelly, is almost certainly higher than Trader A in real life. Nigh because Trader A most likely quit halfway through. Thorp said that in practice he usually used between quarter Kelly and half Kelly, not because he did not trust mathematics, but because he trusted mathematics enough to understand that your probability estimates are never perfect, and a margin of safety is the most practical way to protect yourself from errors in those estimates. This is the point where I want to pause and talk about something extremely important, something that most material about Kelly does not emphasize enough. The Kelly formula is only as good as its inputs, and the most important input is your win probability. If your estimate of that probability is wrong, the entire calculation becomes wrong. Beginners usually do not know the true win probability of the strategy they are using. They feel that the strategy is good, or they backtested a few hundred trades and saw a 65% win rate. But backtesting is not reality, and feelings are even less reliable. There is a phenomenon in statistics called overfitting. When you build a strategy based on historical data, you often unintentionally optimize it specifically for that data. The backtest looks beautiful not because the strategy is truly robust, but because you accidentally created a strategy perfectly fitted to that specific past. When applied to the future, where market conditions are not identical to the past, real-world results are usually much worse than the backtest suggested. What does this mean for Kelly? It means that your true win probability in live trading is often lower than the probability you estimated from backtesting. And if you apply Kelly using overly optimistic estimates, you will risk far more capital than is actually safe. Thorp understood this deeply. He did not simply apply Kelly. He applied Kelly with a large margin of safety, using fractional Kelly instead of full Kelly, specifically to protect himself against the unavoidable errors in probability estimation. Now, I want to talk about how Kelly works in practical reality, not just in theory. And to do that, I will use a concrete example that you can apply to your own trading account immediately. Suppose you are a trader, and you have tracked your trading results for the last 6 months. You have 200 trades in your trading journal. From that data, you calculate your win rate is 55%. Your average reward ratio between average win and average loss is 1.5 to 1. The first step is checking whether the strategy has positive expectancy. Mathematical expectancy equals win probability multiplied by average profit when winning, minus loss. Probability multiplied by average loss when losing. In this case, 0.5, 5 times 1.5 minus 0.4, 5 times 1, which equals 0.825 minus 0.4, 5, which equals 0.375. Positive expectancy. The strategy has an edge. The second step is calculating Kelly. Win probability minus loss. Probability divided by reward ratio. Which equals 0.55 minus 0.45 divided by 1.5, which equals 0.55 minus 0.3, which equals 0.25. Kelly recommends 25% of capital per trade. The third step, and this is the step Thorp emphasized most, is applying fractional Kelly. Instead of 25%, you use half Kelly, which is 12.5%, or quarter Kelly, which is 6.25%. With a $10,000 account, half Kelly means risking approximately $1,250 per trade. Quarter Kelly means risking approximately $625 per trade. These numbers may look smaller than what you are currently doing, and that is usually a good sign. I want to talk about what happens when you compare Kelly to the other common approaches most traders use. So, you can clearly see the long-term difference. That the most common approach traders naturally gravitate toward is fixed percentage risk, usually 1% or 2% of account equity per trade. This is already far better than having no rules at all. But it has a problem. It does not account for the true edge of the strategy. If your strategy has a massive edge, risking 1% per trade is overly conservative, and you are wasting growth potential. If your strategy has a weak edge, or no edge at all, risking 2% per trade may be too aggressive and increase the risk of ruin during a bad losing streak. Let me give you a concrete example. Suppose two traders both start with $10,000. Both use the same strategy with a 60% win rate and a 2-to-1 reward ratio. Trader A uses fixed risk of 2% per trade. Trader B uses quarter Kelly, approximately 10% per trade. After 100 trades, with results matching their statistical probabilities, 60 wins and 40 losses arranged in different sequences, their accounts will grow at very different speeds. Trader B, despite experiencing larger fluctuations along the way, will accumulate capital significantly faster over time because his position size matches the true edge of the strategy. Kelly solves this by adjusting bet size according to the true edge. Strategies with larger edges are allowed larger position sizes. Strategies with smaller edges must use smaller position sizes. This is mathematically natural and logical. But most traders do not operate this way. Another common approach many traders use is completely fixed size. This, for example, always trading one lot, or always buying 100 shares, regardless of account size. This is the worst approach, because when the account shrinks, the true percentage risk actually increases. And when the account grows, the percentage risk decreases. You are risking more precisely when you are likely performing worst. Kelly automatically adjusts to current account size. When the account grows, absolute position size grows with it, while the percentage risk stays constant. When the account shrinks, absolute position size shrinks as well to protect remaining capital. This is a self-protection mechanism built directly into the formula. I want to tell you about one of the most beautiful real-world applications of the Kelly Criterion that Thorp ever implemented. Not in casinos, and not in the traditional stock market, but in the options market. In the late 1960s and early 1970s, the American options market was still extremely underdeveloped and frequently mispriced. Thorp, using mathematics to calculate the theoretical value of options, could identify moments when the market priced an option significantly above or below its true value. When he found a mispriced option, he knew he had an edge. The next question became, how much? And this is where Kelly entered the picture. Instead of putting all his capital into an opportunity that appeared almost certain, he calculated Kelly to determine the optimal size while simultaneously hedging overall market risk. The result was a strategy that, for 20 consecutive years, never had a losing year. Not because he was never wrong about individual trades, he was wrong many times. Oh, but because even when he was wrong, the size of each mistake was controlled by Kelly in a way that prevented a sequence of mistakes from destroying the entire account. Now, I want to talk about the most common misunderstandings about Kelly, because I know that after hearing this video, some of you will research the topic further and may encounter confusing information. The first misunderstanding: Kelly tells you when to enter a trade. No, Kelly does not address that question at all. Kelly only tells you how much capital to risk on an opportunity, assuming you have already determined that the opportunity has positive expectancy. Determining which opportunities are good is an entirely separate problem that Kelly does not solve. People often confuse these two problems. They think learning Kelly means learning how to trade. It does not. Kelly is about capital management after you already have a trading strategy. The second misunderstanding: Kelly guarantees that you will win. Nothing guarantees victory in financial markets. Kelly maximizes long-term growth rate if your probability estimates are accurate and you have enough time. It does not protect you from short-term losing periods. And if your probability estimates are wrong, Kelly can actually make things worse because it instructs you to bet heavily on a strategy that may not truly possess the edge you believe it has. The third misunderstanding: Kelly tells you what percentage of your account to put into each trade. Technically, this is true, but incomplete. Kelly calculates the percentage of capital you should risk, not necessarily the percentage of capital you should allocate to the trade itself. This distinction is extremely important in real trading. If your stop loss is 5% below your entry, and Kelly says you should risk 10% of capital, then you would need a 200% position size to truly risk 10%. That is usually unrealistic and impossible without leverage. In practice, the correct application is this: Kelly determines the maximum percentage of capital you are willing to lose on a trade. Then you calculate position size backward based on the location of your stop loss. The fourth misunderstanding, and this is the most dangerous one: Kelly is the perfect betting formula for every situation. No. Kelly was designed for a specific scenario, repeatedly making the same type of bet with the same probabilities and reward ratios. In real trading, every trade may have different probabilities and different reward ratios. Markets evolve over time, and your trades are not completely independent from each other. This does not mean Kelly is useless, but it does mean Kelly is a guideline, not a perfect mechanical formula. Thorp always used Kelly as a reference point, not as an absolute law. I want to dedicate a section to what I call the Kelly paradox, because I believe this is the deepest lesson inside the formula, deeper than the formula itself. Kelly shows you that there is an optimal bet size, and both betting too small and betting too large reduce your long-term growth rate. What is fascinating is that betting above Kelly does not merely slow growth. It can actually turn long-term growth negative, meaning you can lose money over the long run even while using a strategy with positive expectancy. Let me explain with an extreme example so you can clearly see the mechanism. Suppose your setup has a 60% win rate, a 2-to-1 reward ratio. Full Kelly equals 40%. Now imagine that instead of using Kelly, you risk 90% of capital on every trade because you feel extremely confident. Winning trade: capital grows from 100 to 280. Losing trade: capital drops from 280 to 28. Winning trade: capital grows from 28 to 78.4. Losing trade: capital drops from 78.4 to 7.84. You won 2 trades and lost 2 trades, a distribution fully consistent with the expected 6,040 probability, but your capital collapsed from 100 to 7.84. You lost more than 92%, even though your strategy was statistically correct. This is what mathematics calls the asymmetry of percentage gains and losses. When you lose 50%, you need a 100% gain to break even. When you lose 90%, you need a 900% gain to break even. And when position size becomes too large, losses drag capital downward in a way that future gains cannot realistically recover. Kelly is the formula that tells you precisely where the boundary lies between optimal growth and slow destruction. And betting above Kelly, no matter how good your strategy may be, will eventually produce worse outcomes than betting below Kelly. Now, I want to talk about the psychological side of Kelly, because this is the part that most books and videos about Kelly completely ignore. But in my opinion, it is the most important part in real-world trading. Knowing the Kelly formula is easy. Applying it consistently while the market is moving violently, while you just experienced a losing streak, while you see an opportunity that looks too attractive not to increase size, that is the real challenge. There are 3 specific psychological situations where Kelly most commonly breaks down. The first situation comes after a winning streak. You just won 8 trades in a row. Your account is at an all-time high. You feel unstoppable. You naturally think, this setup is working perfectly. Why not increase size a little? This is exactly when Kelly discipline becomes most important. Because in reality, after a winning streak, the probability of the next trade winning or losing remains exactly the same as before. The market does not know you just won 8 trades. The feeling of being on fire is not information, it is emotion. And increasing size based on emotion is violating the Kelly principle. The second situation comes after a losing streak. You just lost 5 trades in a row. Your account is down 15%. You still believe the strategy is good, but you want to recover faster. You begin considering increasing position size to make the money back. This is the most dangerous situation, because Kelly says the exact opposite. When capital decreases, absolute position size must decrease as well, not increase. Kelly protects you from betting larger precisely when your psychology is weakest and your account is most vulnerable. The third situation happens when you encounter a setup that appears especially perfect. This is not an ordinary setup. Everything aligns perfectly. You think, this time, I can go slightly bigger. This is the trap that intelligent people are especially vulnerable to, because intelligent people are very good at constructing reasons why this situation is somehow different. But Kelly does not distinguish between special setups and ordinary setups, because you cannot truly know whether a setup is special until after it is over. All you actually have is probability. And Kelly already incorporated that probability into the position size. There is a simple way to test whether you are truly following Kelly or merely using Kelly as an excuse to justify what your emotions already want. Ask yourself, if I ignored Kelly completely and traded purely by feeling, what size would I choose? If that number is significantly different from the Kelly number, that is a sign emotion is interfering with the process. People who apply Kelly consistently often describe a strange feeling. Trading becomes more boring. The excitement of oversized positions disappears. The drama of monitoring every tiny fluctuation disappears. And according to many experienced traders, this is exactly the sign that you are finally doing things correctly. Good trading is not dramatic trading. Good trading is boring, consistent, and steadily profitable over time. I want to share with you the most practical way to begin applying Kelly starting today, as you do not need a mathematics degree, and you do not need complicated software. Step 1. Build real trading data. Kelly only has meaning if you know the actual win probability and actual risk-reward ratio of the strategy you are using. If you do not yet have a trading journal with at least 100 trades, you do not yet have enough data to calculate a meaningful Kelly number. The first step is to begin recording everything starting today. Step 2. Calculate Kelly using real trading data, not backtests. Backtesting results are usually more optimistic than reality. Use your actual live trading results, even if they do not look as beautiful. Step 3. Apply quarter Kelly, not full Kelly. If full Kelly suggests 20%, you use 5%. It sounds overly conservative, but remember, your probability estimates may be wrong. And quarter Kelly helps ensure that even if your estimates are significantly wrong, you still survive. Step 4. Review the data every quarter. As you accumulate more real trading results, your win probability and reward ratio estimates become more accurate. Update your Kelly calculations accordingly. Step 5, and this is the most important step, never violate your Kelly limit for any reason, no matter how beautiful the setup looks, no matter how confident you feel, no matter how many losses you just experienced and how desperately you want the money back. Discipline in following Kelly is more important than the Kelly formula itself. Before moving to the next section, I want to share something interesting that very few people know. The Kelly Criterion was not only used by quantitative traders like Thorp, it was also applied, sometimes more intuitively than mathematically, by some of the most famous investors in the world. Warren Buffett and Charlie Munger at Berkshire Hathaway became famous for concentrating heavily into a small number of positions when they discovered truly exceptional opportunities. That is exactly the spirit of Kelly. Bet more when the edge is large. Bet less, or not at all, when the edge is small or unclear. Munger once said that he did not invest in opportunities where he was only 55% confident. He waited until he felt 90% confident before betting heavily. This is intuitive Kelly. You do not need to calculate every decimal perfectly, but the core principle remains the same. Now, when the edge is obvious and significant, bet larger. When the edge is uncertain or weak, bet smaller or do not bet at all. Before discussing why Kelly is not more popular, I want to mention a real-world situation many traders encounter. What should you do when holding multiple positions at the same time? The basic Kelly formula was designed for a sequence of individual bets, but in reality, many traders hold multiple trades simultaneously. The key principle to remember is this. The combined risk of all open positions should not exceed the Kelly risk calculated for a single trade. If Kelly suggests risking 20% of capital and you currently have 4 open positions, then each position should risk only 5%, so that the total combined risk remains at 20%. This is a simple principle, but very few people apply it consistently. Now, as there is a question I know many of you are thinking about right now. If Kelly is so powerful, why does not everyone use it? Why is it not more popular inside the trading community? In my opinion, the answer is this. Kelly forces you to confront uncomfortable truths about your strategy. To apply Kelly, you need to know the real win probability of your strategy, and that means you must record and analyze your results honestly, not only remembering your winning trades, not only remembering the beautiful setups, but recording everything, including the trades where you broke your plan, the trades where the market moved against you, the trades where the setup was not as good as you originally believed. Many traders avoid this process, because when you study your data honestly, you may discover that your strategy does not actually have positive expectancy. Or perhaps it does have positive expectancy, but far smaller than you originally thought. And if that is true, Kelly will either tell you not to trade at all or tell you to trade very small. This is something people addicted to excitement, people who trade more for stimulation than for profit, do not want to confront. And this is also why Kelly never became extremely mainstream. It requires a level of honesty with yourself that many people are unwilling to practice. But there is another way to look at this. If your data shows that your strategy does not have positive expectancy, Kelly is doing you an enormous favor. It is telling you the truth before the market teaches you the same lesson in a far more expensive way. Instead of slowly losing money for months with a strategy that has no edge, you discover the truth early and can adjust. Thorp often said that one of the most important skills in investing is knowing when you do not have an edge and refusing to trade during those moments. Kelly is the mathematical tool that allows you to make that decision objectively instead of emotionally. And this is the final thing I want to say about Kelly before ending this video. Learning Kelly is not about learning a formula. Learning Kelly is about learning a way of thinking. That way of thinking revolves around one question that most people never ask themselves before entering a trade. What is my true edge here, and how much should I risk based on that edge? Once you begin asking that question honestly before every trade, you will realize 2 things. First, many setups you believed were good do not actually have a clear edge, and Kelly reveals the truth through numbers. Second, the setups that truly are excellent when calculated correctly may actually allow you to bet larger than you normally would dare to, while still remaining inside mathematically safe limits. That is the true power of Kelly. Not a magical formula, but a mathematical language for expressing your genuine level of confidence in an opportunity by being willing to risk real money at the correct size for that confidence level. Thorp wrote about Kelly and capital management with a sentence that I believe is one of the wisest statements ever made about investing. The goal is not to maximize profit. The goal is to maximize long-term growth rate while controlling the risk of ruin. This distinction is critically important. Maximizing short-term profit usually comes with enormous risk. A year with 200% returns sounds extremely impressive, but if achieving that return requires accepting an 80% chance of destroying your account, and that destruction happens the following year, then you no longer have anything left to continue with. Maximizing long-term growth is a completely different problem. It requires accepting slower growth in the short term to ensure survival in the long term. Kelly is the mathematical tool designed to optimize that exact trade-off. I want to tell you about something Thorp observed during decades of studying markets. He noticed that most great wealth in investing does not come from huge wins. It comes from avoiding huge losses. The traders and investors who survive multiple market cycles, financial crises, and periods of market insanity are not necessarily the people with the best strategies. They are the people who understand how to limit damage when markets move against them. Kelly is the mathematical tool for doing exactly that. Not by avoiding risk entirely, but by risking the correct amount. No more and no less. The people who understand Kelly most deeply are not the ones who use it to become rich as quickly as possible. They are the people who use it to ensure they are still alive in this game 10 years later, 20 years later, while countless others have already been wiped out. And this is what I want you to think about after this video ends. Not the formula, not the numbers, but a simpler question. Every time you place a trade, how exactly are you deciding the size of that position? Based on feelings, based on how confident you feel about the setup, based on how much money other people are risking, or based on a disciplined process connected to probability and the size of your capital? The answer to that question reveals a great deal about why some traders survive and grow across decades, while others, often equally talented and equally hardworking, disappear after only a few years. Thorp did not win because he was smarter than everyone else. He won because he applied consistent mathematical discipline to the question most traders treat as secondary. How much money should I risk? That is not a secondary question. In the long run, it may be the single most important question you ever ask before placing a trade. If your strategy has an edge, Kelly helps you extract that edge optimally. If your strategy does not have an edge, Kelly tells you the truth through numbers, not feelings. And that, in my opinion, is the real reason to study Kelly, not to get rich faster, but to become more honest with yourself about what you truly know and what you do not know when standing in front of the market. See you in the next video.